As debate rages in Dunedin over offshore deep-sea gas drilling, the economic future for the oil and gas industry is under the microscope. A new study that included the University of Otago has given some insight into one aspect of that issue. Professor David Lont from the Department of Accountancy and Finance joins us to explain. Good evening.
Good evening.
Now, tell us about your work. Who was involved and what was studied?
Well, some colleagues from UC Davis and I looked at the market response or the investor response to some of the global warming science which has been coming out. We looked at some of the largest US oil companies and measured their market response to some of those reports.
Tell us about the carbon asset stock price bubble. What is that?
Well, the science is telling us that we can't go beyond 2 degrees Celsius for global warming without causing catastrophic impacts. And if that's true, then the oil reserves, coal reserves and gas reserves of these big oil companies might become unburnable. And so therefore, if they're assets on the balance sheets, then the argument goes that you could lose a lot of the value of those companies.
But you say that investors aren't particularly worried about it. Why is that?
I wouldn't say they weren't worried about it, but the media tends to pick up on some of the negative connotations of that without thinking about through all the possible positive aspects to that. Essentially, investors have probably taken it into account and discounted the price down sufficiently to take care of some of that risk.
Now, your study suggests that investors aren't naive about the science involved. How did you come to that conclusion?
It comes about because we can measure a response to these news releases, and it is negative, and so it's about $27 billion to the 63 companies involved. But that's not a lot relative to their wealth or their assets. So we can get a response, but there are lots of other reasons why it may not be as dire as has been suggested.
Now, you looked at media coverage of the issue. What did you find?
Well, what we were interested in is, was there a very strong response to the initial science, or was there a delayed response? And what we found was most of the response was to the initial release of the science, but the media has picked up on this issue about a year or two later, and they've become more and more increasingly aware of the issue. There is a reaction to some of that, but it's mainly already being impounded in the price.
And the study asked how well the press serves the public and company stakeholders in terms of reporting the science. What was the result?
Well, I don't think we can be too prescriptive there, but what we do find is that the headline is typically negative without really looking at some of the reasons why you would expect a more muted reaction. And some of those reasons are things like tax subsidies by major countries and the use of science to capture carbon and transition fuels moving from coal to gas and the like. And so it's not as negative as it first appears.
What is the future like, the economic future for fossil fuel companies?
I think they're probably in transition. If the science is correct, and the evidence seems to suggest that the science is correct, then we need to transition away from fossil fuels. But the reality is that oil and gas will be with us for the next 20 to 40 years.
Professor David Lont from the University of Otago, thanks very much for your time.
Thank you.